Dinesh, just wanted to understand, is it fair to assess that IndiaMART is focused mostly on SMEs at both ends, which is buyers and suppliers, whereas most of the peers are focused on large enterprise buyers? Thank you.
Thank you. On the new channel versus self, I think the channel has been developed over a period of last 18 months or so, and we continue to invest behind channel development. Currently, I think new sales acquisition is slowly towards.
Sorry, can you mute yourself, please?
Slowly approaching towards half and half. So half of them are coming from the people who are completely managed by IndiaMART. They are still on a different third-party payrolls, and the second part is the channel. So half is started to come from channel. On your question, why the channel cost is still increasing versus the collection from the last quarter. So collection from the last quarter is Q4 quarter, and Q4 most of our collection comes from existing customers. However, the channel is deployed for the new customer acquisition. So if you see, channel cost will probably start to stabilize in some quarters or so. But for now, collection and channel costs are not related to each other in a direct manner for now. On the competition segment, to some extent you are right that we are more of a marketplace, we are more of a network effect business where buyer and supplier both comes, and many of the names that you took are typically focusing on trading of goods rather than matchmaking and network effect. So to that extent we are very different. However, but after matchmaking also the buyers and suppliers transact with each other. So that from that perspective we are similar. And none of them are actually solving full discovery issue. So currently, if you look at whether it is price discovery, product discovery, model discovery, supplier discovery, I think there is no better platform than IndiaMART with 70 lakhs of suppliers and about 8 crore products.
Sorry, Dinesh, there is some disturbance from your side. If you could just repeat that.
Yeah. So there is no other platform like IndiaMART. It's all the is as good as IndiaMART. So whether it is 7.2 million suppliers or whether it is 86 million products, we get a wide variety of the products and suppliers on IndiaMART platform. So in that respect, I think we continue to perform better year on year over any other platform that you can see right now.
This is very helpful, sir. Just small follow-ups. So one is on the inbound, your own employees acquiring new customers versus channel partners. So last I remember, I think you had said that around 500 of your own employees were also acquiring customers. Is that number similar or is that come down now? Secondly, on the explanation you gave on competition, just wanted your thoughts on the government's ONDC marketplace, because that comes up for discussion very often.
So on the employee side, the 500 people that you see on the new customer acquisition, they are sales supervision people. So they are managers who are overseeing the channel, they are managers who are overseeing the branches. So those are the people on the IndiaMART payroll. And rest everybody is on channel and other third party. On the ONDC, it is something as a concept evolving and very early. And as and when more clarity will emerge, we will try and see where to collaborate and where to compete. But I think it will be more of a collaboration if at all it becomes positive. So, and it is mostly for B2C consumers. For B2B consumers, I think it is still maybe 5 years away after we become successful on B2C side.
Great, thank you. Appreciate it.
Just a minute. Ravi, are we properly audible?
Now you are audible. There was some disturbance in between, but I think it's all clear now.
Thank you. Let's proceed.
Yeah. So next question is from the line of Abhishek Bhandari from Nomura. Abhishek, go ahead with your question. So sorry, Abhishek, we cannot hear you. Please unmute yourself. No, still we can't hear you. We can see you, but we can't hear you. So we can move on to the next participant, Pranav from Edelweiss. Pranav, please go ahead.
Thanks for the opportunity. My first question is regarding the cost. The cost, we typically used to see some decline in Q1 from Q4, but this quarter there was an increase. So how should we see in the next couple of quarters cost going up? That's my first question. And secondly, if I look at two factors, one is the unique business inquiries and traffic. That has sort of plateaued and sort of started decline. Can you give me some more color on, what is happening? If there are any cuts which are actually leading to, decline, or how is the underlying traffic behaving?
So let me address the second part, and then I will hand over to Prateek for the first part. So on the traffic and unique business inquiries, they have stabilized. I don't think that there's 1-2% decline is of any meaning. And thankfully it is, because if you look at the segmental side, what had happened is a lot of stress items were in demand during the COVID times. Thankfully, there are, whether it is mask, whether it is sanitizer, whether it is medical equipment, whether it is medicine, a lot of that demand has waned away. The other part is that especially in the month of April, post JFM quarter, there has been a huge price rise in various commodities, and that probably led to some tapering of demands. But this is very seasonal. I guess we should not have very much worried on those sides. We should be fine on the buyer side. From pre-COVID levels, we are up almost 33 to 40% on the buyer KPIs. If we can maintain these for next couple of quarters and then start to grow slowly at 10 to 20% per annum, that should be fine. Prateek, you want to add the how the people side and cost?
Sure. Pranav, as I've already spoken about, we continue to invest behind growth, and therefore have also added manpower in this quarter. So almost 163 new employees have been added. Because of which, if you see the total manpower cost, consolidated manpower cost, was 87 crores last quarter, has moved to 93 crores. Of which like 2 crores is on account of this increase, and remaining is on account of addition of accounting and software vertical into the business. Other than that, the cost have been going up largely in line with the customer additions, whether it is the hosting of the new customers, so all those volume linked costs. Overall, for the going forward, what we foresee is that cost will increase pretty much in line with the revenues, and we expect to maintain similar 28 to 30% for the next 3 quarters. In the line, we continue growth investment.
Sorry to interrupt, Pratik, once again. Yeah, the audio is not very clear. It's breaking up. So can you just double check connectivity at your end? Is it good?
Sure. So, Ravi, should I repeat the answer again, or you could hear only part of that what I spoke?
So I think we heard half of it. So if you could just repeat last couple of lines.
Just a minute, Ravi. Let us check the connection once again.
Yes, please. Yeah.
Just give us a minute.
Sure. So let me just repeat the answer, Pranav, to your question on the cost. What I was explaining about the cost was the last quarter. We had a total cost of 144 crores, which increased to 160 crores in this quarter. And primarily, if you see the primary component of the cost, which is manpower, it increased from 87 crore last quarter to 93 crores this quarter, of which almost 4 crores has been on account of addition of accounting and software vertical, and the other is because of the normal increase in the manpower of close to 160 odd people in this quarter which we have added. So we will continue to make these investments and continue to add employees which would be needed for the growth in the business. On the overall basis, we expect our margins to remain stable at 20 to 30% for the next 2-3 quarters. Every time we continue to be in the growth investment phase.
Okay. And I also wanted to ask a bit about Busy. Busy has shown a good margins. So how should we see the growth for this business going forward? And have you started seeing any benefit, because of the integration, cross-selling, etc., which will aid growth or margin?
So Pranav, as I mentioned, the focus in Q1 for us has been that given that acquisition causes anxiety amongst people, amongst the partner networks, and we also need to go ahead and strengthen the basic financial systems, our focus essentially has been on doing that well. And as I said, we've come out fairly well. We should be able to start focusing on building up the sales team in Q2, and then start to build up on the partner network, in Q3. And I think these 2 quarters, Q2, Q3 put together, I think should give us a very good view on how the business will move going forward. We should be able to come back to you with a lot more clarity once we've sailed through this initial period, where it is important to ensure that the acquisition and this whole transition actually happens very well.
Okay, sure. Thank you. Wish you all the very best. I'll come back in later.
Thank you, Pranav. A reminder to all the participants that you may use raise hand option on your screen if you wish to ask question. And please accept the invite to come on stage and ask the question. Yeah, Abhishek Bhandari, you can go ahead now.
Hi, this is Abhishek Banerjee from ISET. Again, really sorry, I couldn't hear your explanation on the cost side. Are you saying that manpower cost and outsourced sales cost are going to be in the same, are they going to be continuing the same trajectory going ahead?
Yeah, so what I said was that the manpower cost and the outsourced sales cost, both of them will grow in line with our overall customer growth. So what we are anticipating is that as we are continuing to invest behind this growth for the next 2-3 quarters, our overall margin will remain pretty stable to where they are. And after that, we will start showing some growth.
Okay, so for the next 2-3 quarters, they should remain elevated, and then it will be in line with revenues. No.
Yeah, if you are comparing them with the previous year, then obviously yes, they will remain elevated. But if you are comparing them from Q on Q level, I think as the revenue growth is now on a standalone basis at IndiaMART is about 5-6% Q on Q. I would say that similar increase you should assume in the manpower cost and the sales cost. So that we will maintain about similar 30% EBITDA margin.
Got it. So, do you share any numbers on average order values that your paying customers are seeing? Because I saw a slide on ROI for you. Can you share any metrics on the ROI that a paying subscriber is making on your?
I think many quarters ago I had shared some data around this. Average order value, because IndiaMART is a horizontal platform, is very difficult to say average, but because there are clothing, there are machinery, and there are cranes, and there are raw material. However, whatever little information that we get from our own survey, we get to see anywhere between $500 to $1,000 average order value. Our own payment platform, Pay with IndiaMART, where people use that for smaller orders, remote orders, because for larger orders they typically do not use a payment gateway kind of a system. There we see an average order value of about 25,000 rupees. However, the larger orders are not processed through the paywithindiamart.com. As against this, in certain reports, I had read that average order value on Amazon is about $13-14 versus average order on Udaan was about $60 to $75. So our average order value would range almost 10x of that. And in terms of ROI is calculated based upon the number of delivered per customer. And
again, your voice is breaking up, so maybe let's take a moment.
I'm sorry, some intermittent internet problem is happening.
So now it's much clearer actually.
It's better than Dinesh. You can go ahead. Yeah.
So I was saying that that in terms of number of inquiries per customer and the conversion and the average order value for that industry in as compared to the number of at a quite trying to work more on the relevancy side, so that the relevancy-led improvement can happen. In different industry segments, the order values will be different, and typically customers are able to convert anywhere between 5% to 15% of the inquiries that they receive.
Okay, that's really helpful. So, for your platinum subscribers, right? Is there any commission-based charges that you charge them?
Sorry, can you repeat your question? Your voice had broken off in between.
So for your premium customers, platinum customers, I saw that the average charges that you're getting from them, average realizations from them was in the range of 7.29 lakhs, right? So I'm guessing that is not, sorry, 7.9 lakhs. So I'm guessing that is not a one-time subscription charge, right? Is there a commission that you charge them?
Sorry, you're getting some network. You can type in the question box.
Yeah, I do that. I'll write it. Thanks.
Type it in the question box. Ravi, just read out the question, whatever he types in. Okay.
Right. So moving on then. So next question, Anmol Garg, please go ahead with your question. Please unmute.
Hi, thanks for the opportunity. So just had a couple of questions. Firstly, we added some 226 employees in product and tech this quarter. Will it be entirely related to busy infotech, or we have also increased the intensity of our tech hiring? That's one. And secondly, wanted to have a view on margins. That we are giving an estimate of adding 8 to 9,000 paid suppliers every quarter. So just wanted to understand that our sales and like you said that our sales and employee cost will increase in that manner. However, can we expect any advertisement revenue also coming through into the company to increase our traffic share, and can that impact our margins as well in the next year or going ahead as well? So that are the two questions from my end.
Thank you. Let's first talk about product and technology.
Sorry, Dinesh ji, your voice is not audible. Once again.
Ravi, is it any better now?
It's much better. Let's start once again.
Okay. First, talking about the product and technology employees. In the last 2 years, we haven't hired any product and technology employees, and we had given offers to the campus in this entire last year. And people had started to join as a trainee from January, and most of the people they completed their examination and became permanent in this particular quarter. And that's why you are seeing a step function jump in the employee count. So we have actually beefed up our product and tech team, knowing that the market is going to be tough for product and tech. We need more people. We have expanded multifold into different products. As you can see, our CRM has become quite mainstream, and we are also trying to do experiments around various more engagement features on the relevancy improvement, category-based improvement, as well as trying to experiment more on the payment and credit side. On the busy also, I think 180 total employees have been added.
There are total 181 as of 30th June. But the entire addition of product and tech team that you see here is on account of people who joined IndiaMART. This is not on account of people at least.
The second question was around the margin. So, I said the people will.
Sorry, Dinesh, not audible. Sorry to interrupt once again. So maybe you can now start answering the second question, please.
Yeah, the second question was around margins. So as we guided that margins will remain in the range of 30-odd%. As we are adding these new customers are added at the lowest ARPU in the entry level segment, in the silver monthly and silver annual. As these customers will move up the value chain over the years or so, that will improve the margin. So as the customer base increases, the margin typically start lower. As the customer moves up, becomes older, then the margins improve. And you can see the top 10% customers ARPU is around 220K. and top 1% customers ARPU is around 790K. However, the overall ARPU is about 46K, while the silver monthly ARPU is about 2.5 thousand per month, which is about 30,000.
Just wanted to understand that can we expect IndiaMART to spend more on advertisement as well in coming years?
Yeah, as we have always guided, if at all we decide to do any advertisement, it will be to the tune of 30-40 crore rupees per annum. However, we feel that last couple of years there has been more buyers than sellers. We are trying to build more supply on the platform, more responsive supply, more. So I think current year or so, we don't plan to spend anything on our 100% acquisition remains organic, and we believe that it will remain so for the next year or so in advance.
So my first question is on the supplier front. So although we are seeing a 10,000 increase in the supply, if we have lost any?
It is the net added, sir.
Yes, so if you are asking about the churn, we give the churn numbers quite frequently in every call. The top gold and platinum customers, the churn remains less than 10% per annum. In the silver annual segment, the churn remains around 25% per annum. And in the silver monthly segment, the churn typically.
Sorry, sir, your voice is breaking out.
As I said, the churn in the gold and platinum segment, the churn remains at less than 10% per annum. In the silver annual segment, the churn becomes about 20 to 25% per annum. And in the silver monthly segment, the churn is about 5% per month.
Okay. And my second question is, sir, on the current scenario, what we see is that the focus has been towards the manufacturing sector and the product sector. So are we looking forward to move towards the service sector as well as IndiaMART service?
Yeah, I mean, on a large macro side, dividing that into manufacturing, I think many service providers are our customers also. We go by small category by category, so business services, construction services, that kind of it. And I think we continue to expand into more and more categories to monetize better, and we will continue to do that. But are we going to go into B2C services? I don't think so. We will continue to remain B2B services.
Not specifically to B2B or B2C, sir. I'm talking about the services, the service segment sector. As we are focused towards the manufacturing sector, like industrial plants, machinery, or the construction or the machinery parts, are we focusing on the service segments as well? Supposedly IT services or the financial services.
IT services and financial services, but you will see software, many software companies. You will see many call center companies. You will also see many consultants. You will see many chartered accountants and logistics service providers, transportation, that kind of services.
Okay. Yeah, that was my question. Thank you, sir.
Thank you, Ratik. Next question is from the line of Amit Chandra, HDFC Securities. Amit, please go ahead. Amit, please unmute. Yeah. Hi. Yes, you are audible.
So my first question is on the on the customer addition, that is mostly on the mostly on the monthly like subscribers. So what percentage of the monthly subscribers get converted to maybe a long term, whether how many of them that we add like remain with us, because you have mentioned that the churn is coming down. So like what kind of impact it is going to have on our ARPUs over a longer period of time. And also in terms of the addition that if I see the incremental ARPU, that is obviously on the lower side. So obviously, are we providing some kind of discounts to get suppliers on our platform, or the pricing remains the same?
So first, let me answer the easier one first on the long-term ARPU growth. On the long-term ARPU growth, we have guided in the past also. Typically, we try to take anywhere between 5 to 6% CAGR ARPU growth, and that has been the past also, and that will remain similarly there. How does that add up? Yes, you're right. That many of these, first of all, about two-thirds of customer comes in the monthly mode, and one-third of the customer comes in the annual mode. And from the silver customers, many customers upgrade to the gold and platinum over a period of time. Uh, Approximately, I know for sure that approximately 20% of the customers typically upgrade in a year's time. So if you look at the cohort wise, certain customers will upgrade in the second month, third month, and so on. So approximately 20% in a year's period, and that is how the ARPUs increase over a period of time.
And
Yeah, and currently because of the most of the addition is going to happen on the silver side. So in the near term, ARPUs will remain flattish or even could be even muted for some time. But over a long period of time, they will increase by way of upsell and by way of upgrades. On the are we giving discounts? I think that there are no on the silver side we don't offer much discount. We typically remain in a fixed price product. When it comes to the platinum side, we definitely offer customized packages for larger customers.
Okay. And sir, engaging for working
Sorry to interrupt,
suppliers,
Amit.
engaging for
Your voice is not audible.
then in terms of commissions, how the commissions are there? Is it mostly
Amit, can you repeat your questions, please?
Australian or in volumes? Yeah. Can you hear me? Hello.
Maybe Amit, you can turn off your camera. It will
Hello.
save some bandwidth, and repeat your question then.
Am I audible?
Yeah, it's much
Yeah,
better.
you're audible.
Yeah. So no, my question is on the channel partners. So how the channel partner economics actually work? In terms of commissions that we're giving to channel partners, because what I'm seeing is that as you have mentioned that the cost will actually go up in line with the supplier addition. So is it that most of the sales that is coming, or sales like I mean in terms of customer additions that is coming, is mostly through the channel partner ecosystem, or our in-house sales is also adding so
Yeah, as I said earlier, about 50%, more than 50% of the sales currently come from in-house sales channel, and our endeavor is to keep it at 50-50%. And the cost on the employee front will rise because our cumulative customer base is increasing, and we need client servicing and renewal and upsell employees, and those are 100% in-house employees. We have not yet tried channel partner there. We will probably start to think about those, especially in the tier 3 towns. And how the commission works is very like very standard DST mechanism which you see in the banking sector or which you see in the telecom sector. So it is calculated based upon whatever is the cost and whatever is the.
Sorry, Dinesh, your voice is breaking up.
Yeah. So the commission on the sales is to the channel partners or per sale basis and is arrived at based upon the historical cost we have had at IndiaMART.
All right, so I think Amit have left. So we'll move on to the next participant, Manish Gupta from Solidarity Advisors. Please go ahead, Manish.
Yes, thanks for the opportunity. I'm sorry, I'm coming back to a question other participants have also raised. You made a statement, I hope I've understood that right, that employee cost will stay roughly proportionate to how your revenue increases. That's kind of, very counterintuitive because of two reasons. One is one would expect that there would be some productivity of the sales force over time. And secondly, you do mention that people come in the lower tier and then they upgrade to higher revenue per supplier as they move into the gold and the silver and the gold and the platinum programs. So it's very counterintuitive why your employee to revenue ratio just for the standalone business should not decline over time.
Yeah, see, can you see the current slide on the up there?
Yeah.
So on a long-term basis, right? On a long-term basis.
Sorry, Dinesh, I can't hear you. Dinesh, it's a very bad line. One request is just to see whether this is an issue of bandwidth or it's an issue of the software platform you're using. Because this is really a terrible line. This one has been barely able to understand anything on this call.
Are we audible now?
Yes, it's audible now.
It is bandwidth issue. We have used the new conference room. I think there's something wrong there. So
yes,
if you can see the slide, on a long-term basis, the margins will improve, and they have been improving. It is only in the last 2 years where the margins had gone exceptionally high because we have not been investing.
Sorry to interrupt, Dinesh. It's a very bad line. Not able to hear you at all.
The problem is not my voice.
Yeah, no, Dinesh, I think it's just the conference room that aap keh rahe the. May I offer a suggestion that we reschedule this call because, we get to talk to you only once a quarter. And I think there were some very interesting questions that people asked. So if it's not too much of a bother, Dinesh, could we reschedule the call and do it again?
Yeah, we'll talk about it. We'll internally and see if.
Otherwise, I'm happy to do a call offline with Pratik or something.
Yeah,
so, but just as I understand.
Yeah.
What I heard you say was that over time, the reduction in employee benefits, we should continue to see that over time. Is that what you said?
Yes, only for the next 2 quarters or so, it will grow in line with revenue.
Okay, clear. Thank you.
We'll move on to the next participant then. Amit, are you there? Yeah. Yes, Amit, we can hear. Please go ahead with your question.
Actually, my line got lost. So on the cost part of questions have been asked on the cost aspect. But so the adjusted EBITDA margins that you have given, so that is excluding the ESOP cost, if I'm not wrong. And if I exclude the ESOP cost and if I exclude the acquisition impact, then the margins come to around 33%, right? So what we are saying here is that the investments that we're planning and we're targeting 30% margin, because and the margins of like Busy is on the higher side, right? So typically it should have a you know you know like positive impact on the margins. So how do we see the cost aspect, and also the ESOP cost? What would the ESOP cost for the full year, if you can give that, and also on these levels.
Sure. So, one clarification, when we said about 30% margin, that was on EBITDA and not adjusted EBITDA. So that was actually including the stock comp expense.
But you can tell what is the ESOP.
Regarding the ESOP prediction, or as to how do we see this cost. So this cost is primarily on account of the ESOP that we took in the month of January. So for first year, this cost will stay high. For the next 2-3 quarters, it will stay high. And after that, depending upon the amortization schedule, it will come down slightly. So the 7 crores per quarter will continue for next 3 quarters.
Okay. And my last question is
on the Busy side. I know Busy is a very new and very small business as compared to the overall business, and we will make investments in product and technology and sales. So Busy, while you are seeing the current profitability as 40-50%, I think our immediate target on Busy is not about margins, but about expanding the sales and making the product available on mobile and cloud and all those things. So I would say that that 5 crore rupees would not have a larger impact on the operating margin on the consolidated basis.
Yeah. No, so again on the Busy side, sir. So obviously, the run rate that we are showing, it's indicating around 40 crores like full year for the next year. But when we acquired, also the revenue was actually higher. So are we seeing a YY kind of a decline for Busy, or there is some accounting changes that impacting that, and or in terms of how we are recognizing the revenue for Busy, and also in terms of longer term targets, how do you see the like revenue growth for Busy, and in terms of cross sell, how the opportunity is panning out?
So, I mean, two things. One, the earlier financials, if you will see, were based upon IGAP. From this quarter onwards, we have shifted to Ind AS, and therefore, the whole policy of revenue recognition is now as per Ind AS and not IGAP. When you look at a comparable number, for last year, the revenues were recognized based upon the
A few seconds.
Sure.
The line is really bad. We're not able to hear you. Most of the answers we're not able to.
Maybe try Brijesh now.
Correct. Is it better now, Ravi?
Better. Please go ahead.
So, Amit, on a like-to-like comparison basis, if you look at last year, the revenues were based upon the billing. The billing in Q1 is at 13 crores, which means it will be at a run rate of about 52 crores, higher than the revenues which were there last year. Now, having said this, when we look at the focus that we are having on the Busy business, as I mentioned, the first focus is to make sure that the people and the partners, they continue to stick with the business and do not get alarmed by this change in management that has happened. We would be able to go ahead and start focusing on growth from Q2, Q3 onwards, as we start to invest behind growing the team and growing the partner network. In the last call, we had mentioned that the priorities for us in this year would be one to double the rate of growth that generally used to be about 10-12% CAGR to about 20 to 25% in this financial year.
So, just a minute. So could you just repeat the last statement?
Yeah. So as we had shared in the last quarter, our top three priorities in this financial year would be one, to double the rate of growth, from the erstwhile 10-12% to about 20-25% in this financial year. Second is to increase the overall number of new licenses which are being sold, because that would be forming the foundation for accelerated growth in the years to come. And third would be to go ahead and invest behind building the team and improving the overall awareness of the product so that we can ensure better penetration in markets all across India. So these would be the three priorities in this financial year for us.
Okay. Okay, sir. Thank you, and all the best for the financial year.
Thank you.
Thank you, Amit. Next question is from the line of Ajay Modi, Piper Circa Advisor. Ajay, please go ahead.
Thank you, Ravi. Prateek and Dineshji, quick question. So, are we saying that our quarterly employee plus outsourced manpower expense run rate is, which is now roughly about 120 odd crores, will go higher further? So that's my first question.
Yes, as we discussed in the past, that since we are adding manpowers across functions, this cost will go up in line with the addition.
Sorry to interrupt once again. So let's wait for 5 seconds or so.
Ravi, is there an option you can move to an audio instead of the video?
No, you can try and turn off your video, Kushal. Maybe turn off your video and let's see if it is better.
Yeah, we've switched off our video and we'll continue with the presentation.
I think it's better. Let's please go ahead.
Yeah, I can hear you.
Is this better?
Yeah, it's better.
Okay,
Kushal,
so
your presentation, it's not visible at the moment. So if you can just share your...
1 minute.
Yeah,
is it visible now, presentation?
Visible now. Yeah.
Thank you.
Please go ahead.
Okay, so coming back to the question on the employee front, as we discussed right now, that we will continue to add people, and as the people will get added, this cost will increase. However, as a percentage of revenues, it's likely to stay same because the revenues will also grow quarter on quarter.
Understood. But then Prateek, and I think Dineshji can come in here. So our expenses, which were largely flat, we did not do any large hiring, didn't increase team size back in 2020 and 2021, which we've started doing now. My question here is, shouldn't we be sweating these employees more? Shouldn't the growth rate be higher? I mean, for example, you just said that target is to do 25% kind of IRR for or CGR for busy, but for a 40 crore sales, 25% growth is about 10 crores, which is way too small for a company of our size, right? So what my understanding that I'm trying to seek here is, what is stopping us from higher growth? Right now we are at 179,000 active users in the IndiaMART platform compared to 7.2 million storefronts, which is roughly about 2.5% paid to overall subscribers. So what is, I mean, if we have money, if we are spending, if we are hiring, what is stopping us from saying that, look, I will drop my ARPUs lower and I will increase my subscriptions far higher? I mean, we are the market leader. So why are we not cleaning out this market completely?
So let's look at the leading indicators of the growth. So there are two leading indicators of the growth. One is the number of customers, and the second is the collections in the. So if you look at FY21, we neither added customers nor added any collection. So if you look at the collection of FY21 versus FY20, it was a flat collection. And if you look at the number of paying subscribers, it was a flat year. In the FY22 also, the first half was marred by COVID. It was only whatever growth has happened in the second half of the year. Now, if you look at the current trend, so from we have tried to double our customer growth from 20,000, 22,000 per annum. Now we are saying that we will go to 35,000 odd per annum at about 8,000 to 9,000 customers per quarter. So I think we are investing behind growth. Now, why can't we go even higher? That limits my ability to manage. And as we and to people's adoption of internet and businesses adoption, I think we remain committed to a profitable growth business. As we said earlier, also even before the pandemic, our revenues used to grow at 25-30%, cost used to grow at 15 to 20%, and that is what resulted into margin expansion. I think for now, given that we have not done any investment in the last 2 years, currently the margins will remain flat at around 30%. However, as we achieve a higher trajectory, we will again start to focus on margin expansion.
Understood. Quickly, Dineshji, so you said that why can't we go higher? That limits your ability to manage. My question is that, look, for example, we acquired Busy. Busy has a revenue of what, 40 crores. I mean, for doing a 25% growth, 10 crores doesn't even move the needle for IndiaMART as a platform. Specifically for Busy, why are, at what point would we expect a little more aggressive growth here?
As I mentioned, we would be able to come back with much better view on the overall Busy business from next year onwards, because we would have seen through this entire time of integration and assimilation of people and partners, and we will build visibility on acquisitions and revenue growth going forward.
Okay,
I think
understood.
I've already repeated this multiple times during the Busy acquisition process itself, that first year my entire focus would be to make sure that we do not go burst with the acquisition. So I think the most important factor is that this year let us focus on retaining the revenue, retaining the employee, retaining the partners, retaining the customers, understanding the business inside out. And then next year onwards, let's put the focus on growth.
So then if I were to ask you, what is a 3 or a 5 year view with this business? I mean, what size should it become? Not can, but what size should it become?
I've given a long-term, my own expectation that over a period of time, over the next 10 years, can this become a 500 crore business instead of a 50 crore business.
Okay.
Thank you, Ajay. Next question is from the line of Vivekanand. Vivekanand, do you have a follow-up question?
Yes, Ravi, I have two follow-ups. So one is on the investments. There are several startups where IndiaMart's stake is less than 20%, like M1 Exchange or Bizome. Do you see an opportunity to increase your stake in these companies anytime soon? Also, in the next 12 to 18 months, how do you envisage the utilization of cash? Will there be any major new investments or material follow-on rounds that you expect? Second question is on the shift to weekly salary payout. Is that having any bearing on attrition? Is there anything else to call out in terms of attrition? Thank you.
So on the weekly salary, it has been received very well, and I believe that things that we are listening in the market about attrition, we are not that badly affected. But I don't think this can be the only reason for. So maybe if our attrition, if we had a monthly salary, the attrition would have been 1% higher. So I think everything adds up to the attrition. On the minority investment side, you're right that we wanted most of the investments to be around 26%. In many cases, we probably either found it too early to go 26% or the availability to be less than 25-26%. And so in the Zoom over the time, we have increased our share. In Vyapar also, we started with 26, now we are at 27.5. In Logistify also, we started with 10-11%, now we are at 15%. So as and when we continue to assess businesses, and as and when there are any things, we will continue to look for opportunities to increase our size. In 9 out of the 14 investments that you see here are about 25% or more. Specifically about M1 exchange, it's an RBI controlled regulated entity, and no single entity can take more than 10%, being a RBI controlled banking exchange. So we are only allowed to take up to 10% there. We already have 7.7, and as and when we will find the opportunity, we will increase it to 9.9%.
Okay, thank you. Just one last follow-up. Any updates on Vyapar and how the offtake has been and how you are thinking about it now alongside Busy?
Both operate in a very different segment. While Busy operates at more of a small and medium businesses, Vyapar operates mostly at a micro and small businesses. Vyapar, less than 50% of the Vyapar customers are GST registered businesses. In Busy, I think more than 80% or 90% customers are GST registered, and not only GST registered, but I think with good turnover. So Vyapar and Busy actually solving very different needs for very different customer segment. Busy probably is more to do with tally kind of a market, whereas Vyapar is very self-accounting software or DIY accounting software.
Best of luck.
Thank you. Moving on to next participant, Ajay Modi, do you have a follow-up question?
Thanks, Ravi. Dineshji, quick one. We have a very large exposure now to accounting. We have live keeping, real books, Busy, and Vyapar. Can you just throw some light on what is your long-term thought process with all these, and while I understand which pieces of the puzzle do they fit in, what are we looking at from a longer term? I mean, what is the opportunity size that we're looking at?
So opportunity size, if you look at today's market, about 2,000 crore is what the customer pays. About 1,000 crore is what the company's revenues are, because most of the companies have been working on box model, box license model, and on the transfer pricing model. So from the customer side, and I'm not talking SAP and other, only the small business accounting. So that's about 2,000 crore rupees market, and this market has grown rapidly in the after GST. In the GST year, this market actually tripled from being at 300-400 crore market to 2,000 crore, and ever since then it has been growing. and now with mobile and cloud, we believe that this market can become a $1 billion market over the next 10 years or so. Out of that, if you look at major market share has been with Tally, and Tally has been primarily an accountant-led desktop-only accounting software. That our take is that that is going to change. Vyapar came from a mobile-only and DIY accounting, and now slowly and slowly started to offer a hybrid cloud onto desktop as well as mobile. Real Books is a multi-branch, multi-location, simultaneous accounting system. Busy, though it has a historically box-based pure desktop model, but I think our vision is to convert that over a period of time into a mobile and multi-location cloud-based model. So we believe that this is a good business models like stickiness. Customer stickiness is there. It has a recurring revenue stream. Earlier it was in the name of AMC or upgrades. Now I think over a period of time, as we have seen, most of the software is moving into a recurring revenue system. So I think we are looking at currently 1 million businesses are within IndiaMART ecosystem are using our software. So Vyapar is being used by almost 500,000 people. Busy is being used by 3 lakh licenses have been sold. Many people have 2-3 firms being operated on the same license. And similarly, Tally, as per published resources, are about 5 million users on Tally. I think this market is going to only grow. It's been there for almost 50 years now. This market is going to grow only.
But have we, are we already seeing the kind of adaptation here, as in from a expert point of view, what you would have expected in terms of adaptation? Are you seeing that already?
So in the Vyapar, when we first saw Vyapar in the year of somewhere in the middle of 2019, it had less than 10,000 customers. Now we are just 3 years from then, July 19 versus July 22. There are already 120,000 odd customers. So they have added 1 lakh plus customers in 3 years.
Okay. Okay, that's all from my side. Thank you.
Read out a couple of questions from the discussion panel. So first question is, do you charge commission as a percentage of sales from your platinum subscribers to understand the ARPU of 7 subscribers?
No, we don't.
Okay. And now moving on to the next question. What is the registered supplier versus paid supplier ratio? And what is your current conversion rate from the free supplier to the paid supplier?
So about 1,70,000 paid customer and about 70 lakh free customer. So that makes about 2.5% of the customer base which is paid. If you look at worldwide classifieds, they typically have anywhere between 2 to 5% penetration. Whether you look at Alibaba, whether you look at many other 2 to 5% penetration. In our case, being B2B, in certain we look at GST data. Out of the GST data, about 12 million people. There are about there should be about more than 1 million possible customer base over a long period of time.
Okay. So just a follow-up, sir, on this. What would be the strategic focus area, or how do you plan to improve this conversion? Apart from advertising, what would be the key drivers to improve this conversion rate?
We continue to expand, make it easier for people to do DIY, as well as continue to expand our touch points, whether it is online, telephone based, or field based, or now we have expanded through channels also. So we will continue to do that. I would say one of the most important factors in this free to paid conversion is people's own ability to take out take out value from an internet based business. There are, within the same category, within the same geography, there are some people in the same geography, same industry are able to take out better value from IndiaMART, and some people are not, because of the way they are adopted to internet. And as and when more and more people are adopting, more and more businesses are adopting, that is also going to improve over a period of time. We have seen it's been only 5-7 years when this mobile phone has become quite popular, and I think it will continue to improve over a period of time.
Thank you very much, sir. So maybe and now I would like to hand over the call to you, for the closing remarks. Yeah.
Unshare कर दो यहाँ. Ladies and gentlemen, thank you very much for joining our Q1 FY23 conference call. I'm sorry about the internet disturbance that we have had. In case you have more queries, please feel free to reach out to our investor relation department, and they will be happy to answer your queries one-on-one. And we will try to have a better connectivity, tested connectivity next time. Thank you very much. Have a great day and have a great weekend.